Hi and welcome everyone. I'm so glad you can join me today. Today we have a webinar about how financial services can lead the net zero transition. And this webinar is based on a white paper we released just last month together with CDP, Bankers for Net Zero, Nordea and UBS Wealth Management. And we have some of the contributors to that white paper with us here today. If you'd like to know more about the white paper or deep dive into this topic, then feel free to download the white paper. Today's speaker is Laura Bowling, Sustainability Partner at DF Capital, Elena Perez-Celis, Head of Policy Public Affairs at Bankers for Net Zero, Torun Reinhammer, Associate Director Capital Markets at CDP Europe, and Dr. Alexander Schmidt, Head of Science, Sustainability and Climate Research at Normative. Elena and Torun have been great contributors towards the white paper, so we really appreciate their contribution and them being here today. And Dr. Alexander Schmidt has led the majority of the work in the drafting of the white paper and is kind of the master behind this all. So we really look forward to hearing your thoughts and insight. And Laura will be presenting the perspective of a bank and why this white paper is relevant to read and the topics are relevant for banks out there. I'm Cassandra Julien. I'm heading PR and communication at Normative, and I will guide you through this session today. Before we get started, I have some housekeeping rules. We're going to have fun for around 45 minutes today. The webinar is recorded, so it's available to watch afterwards and share with colleagues. If you have any questions, use the Q&A function, and we will try to get to as many of them as possible in our Q&A section. And after the webinar, we have a survey. Please take a moment to respond to that, because that is our easiest way of getting better and sharper and supplying the best possible webinars for you. So with that, let's take a couple of minutes to talk about Normative. Our mission is to make known and reduce the sustainability impact of all economic activities on the planet. But one of the biggest problems in this world is that you can't see carbon. And I can talk about this all day, but as we see over and over again, there is a discrepancy between the emissions that a company is actually accountable for, that is a company is actually accountable for, sorry for the tongue twister, and those that it releases in the atmosphere. And this is what we quite often talk about as the accuracy gap. And it's actually only when you see carbon that you can manage them. And as we normally say at Normative, what gets measured gets managed. So it's absolutely crucial to have those insights in order to lead the path to net zero. Now, why is this important? I think the planetary imperative is pretty self-explanatory. As we heard over and over again, we can't negotiate with climate, right? But there's also the regulatory imperative, and we see that there is legislation coming in new markets all the time. So in the UK and EU, they've been very established, and we've seen a lot of progress in terms of the regulatory requirements and the reporting requirements. But we're also seeing the same trend in the US, and especially now with the latest Californian bill, that there's so much happening in the regulatory space, and businesses need to be prepared for this from a compliance and risk perspective. But then there's also, of course, the competitive imperative, and those businesses that stay ahead of the curve, they can capture those business opportunities. So what we're seeing is that carbon emission is not just a compliance or a tick the box exercise anymore. It's actually a reductions race. And this quote from E&Y Sustainability Report makes that crystal clear. Companies that use climate data to build real reduction initiatives outperform those that don't by a factor of 2.4, which is pretty clear. You know, taking climate action is good for your business. And our approach at Normative, so we are based on a foundation of scientific integrity, and it's at the heart of everything that we do. And with responsive insights, we make carbon visible across scopes 1, 2, and 3 emissions with actionable insights for businesses. And through our connected and continuous actions, we provide insights across your suppliers, making sure that you have the data, the reliable data that you need in order to make those reductions on a regular basis. And with our ecosystem, we make sure that you are connected to the partners that you need in order to reach net zero emissions. And if you see the pop-up, feel free to book a demo if you want to speak to one of our experts at Normative. We come from academia, government, and tech. So our founder and CEO, Christian Rönn, previously worked at Oxford University with mitigating climate risk. And we are at the heart of legislative discussions and policy developments, and we collaborate with leading organizations such as UN and tech organizations such as Google. To give you an example of companies that we work with, Hitachi, SEB, Danone, just to mention a few, but what you can see, the trend across these is that these are businesses with either complex value chain or deep scope 3 emissions. And that's typically the businesses that we work with at Normative. Before diving into the topic, I want to take a moment and promote the Normative Net Zero community. So this is a community for peer-to-peer collaboration. We have specialized webinar, we have newsletters with legislative developments, deep insights, and we do meetups regularly. If you want to sign up to the community, feel free to use the pop-up. And we actually have our next webinar coming up in just 2 days on Thursday, where we're going to deep dive into the latest in terms of legislation. So if you're curious on what's going on, join the community and join me on Thursday when Dr. Alexander Schmidt and I will dive into these topics. And of course, follow us on social media if you're not doing that already. That's a great way to staying up to date with everything going on at Normative. So with that, let me start by introducing Dr. Alexander Schmidt, and let's dive into today's topic.
Thank you so much, Cassandra, for the intro. As you already advertised, so we're going to focus on how financial services can actually lead the net zero transition. And I promise this time you won't hear a lot from me, but we have great speakers that I want to get on stage as soon as possible. I also want to make sure that everyone is being picked up where they are and we all can start on the same page. So let me just quickly highlight the urgency with which we have published this paper, because there is an urgency to act from businesses, especially in finance. What we see right now is economic impacts, real world impacts of climate change is being felt. Climate-related disasters have cost the world about 650 billion just in between the years of 2016 to 2018. So that's a huge amount. And if you look forward into the future, if you continue on the path at which we are right now, GDP is estimated to shrink by about 18% until 2050, and that would have catastrophic impacts on the real-world economy. So real-world events, climate events, have impact also on our global economy. So we need to act. And why finance? Well, because finance is really, really key for the net zero transition. We rely on capital. There's a huge funding gap that has to be bridged. Importantly, it has to be bridged with investments into the right technologies, into the right companies. So finance is the vehicle that can really enable this transition towards net zero. At the same time, very importantly, the net zero transition is also critical for finance. Carbon emissions are increasingly becoming an operational risk for financial institutions and other related organizations, because they invest in companies, they have carbon in their investments, and this will, as we've seen, based on the economic cost, those will become subject to physical risk, liability risk, etc., through the changing climate around us. Cassandra, you also already mentioned regulatory imperative. So there's also a huge push from regulatory bodies to be more accurate on your disclosures in finance. So financial services industry, they have to tackle the net zero transition themselves as well to stay relevant. So against the backdrop of these global developments and the relevance of finance for net zero and net zero transition for finance, I would love to now welcome our panelists, and Cassandra, you will guide us a bit through these next few sections.
Exactly. Welcome, Turon, Laura, and Elena to the stage. So we divided this discussion into 3 sections, and we're going to start with the first topic. What are the recent trends within finance when it comes to environmental disclosures? So Turon, from your perspective, has the financial sector recognized the relevance of the net zero transition? What is your opinion on this?
Well, you can see different ways. I mean, we see encouraging signs, for instance, that many financial institutions have joined different net zero initiatives. And as we mentioned in the white paper, we saw a rapid increase in financial institutions disclosing to CDP between 2020 and 2022. Those were the first 3 years where we had actually a sector-specific module in our questionnaire that targeted the finance emissions and portfolio impacts. But unfortunately, this is still a relatively low number, so only around 550 globally, which is less than half of those financial institutions that we actually asked to disclose data to our platform. And this number also has stagnated in 2023, so it's not evident that this upturn is continuing. And what is also worrying is that we scratch a bit on the surface. Not even half of these financial institutions state that they have a climate transition plan that aligns with 1.5 degrees. This is one of the questions we ask in our questionnaire. And it can sometimes be intriguing what those transition plans actually are based on, since the amount of Scope 3 emissions related to portfolios is often sketchy. And furthermore, when we look at the emissions emission reduction targets that the financial institutions have disclosed to CDP or to the Science Based Targets Initiative, you can say the picture gets even worse or really grim. So among asset managers, banks, and insurance companies, CDP calculations show that 117 had targets for Scope 1 and 2. That was 1.5 aligned last year. But as you know, that figure is largely irrelevant, as we know that Scope 3 is by far the largest for financial institutions. So actually less than a handful of financial institutions globally had a Scope 3 target that was compatible with 1.5. And in many cases, also organizations have actually not disclosed what their transition plans look like. So it's very difficult to know whether they are actually proactive, working proactively with this towards the targets. This is based on 2022 disclosure, and I hope to see some improvement in 2023, but I don't expect it to be huge. And actually, it's not surprising, because after all, FIs are also dependent, right, on the real economy around them. So CDP data showed last year that less than 1% of the almost 20,000 companies that responded to CDP had credible transition plans in place. And of course, there is a big task here for financial institutions to upskill their portfolio companies on this. Another area to watch is nature. It's a well-known fact that there will be no net zero without considering nature. And nature is also a silent stakeholder according to ESRS, which needs to be taken into account. But still, just 1 in 10 financial institutions measured their nature-related impact in 2022. So much more work to do there going forward. Otherwise, the financial institutions will never manage to reach any net zero goals.
Thank you. So clearly there's a huge gap in terms of, the commitment and the kind of intentions and the actions that we're seeing in the net zero plan. And this goes back to my presentation about normative. It's only when you see carbon that you can actually action it. You need those actionable insights. You need to understand your Scope 3 emissions before you can actually do something about it. Laura, moving to you. You're representing a kind of smaller UK bank. What are the pull and push factors that you feel when it comes to environmental disclosures, and what are the challenges these impose on you as an organization who actually have to do the work implementing them?
I think there's quite a lot to begin with, but obviously the main push factor is the regulation. I don't think a lot of companies or financial institutions would be on this journey if there wasn't any regulation in place. So for us as a UK bank, it's the SECR, and we're disclosing our scope 1, 2 and 3. But I think alongside that, as we will cover that like quite a lot, as a bank, it's investor pressure, especially as we're a small bank. So our investors are really important to us, and they're asking a lot of questions within this space, and they just want to make sure that their investment is in a business that is doing well and doing good by the environment, and doesn't have any negative connotations or bad press or anything like that. So there's obviously a lot of pressure from those stakeholders, really. And it kind of leads on to another push factor of reputational risk. You see with a lot of non-financial institutions and now beginning financial institutions that there's bad press associated with whether they're unreliable disclosures, unreliable claims like greenwashing or anything like that. So every firm, whether you're a bank or not, doesn't want that negative press. So you want to be on the right side. You want to have progressive change. You don't want to be seen to be not doing anything, or to be doing something that is greenwashing, or to be continuing in harmful practices. But I think with that push factor, you can kind of turn it into a pull factor of this is such a great opportunity for financial businesses who have sometimes had a bad reputation to improve their reputation and show that they really do care and they really do want to do the right thing, and admit that it is the responsibility of everyone. But with financial institutions being able to shift demand and supply, that is where they can really like come into play. But then from a business perspective, a pull factor is the opportunity that this has. So there's so many opportunities within the financial institution space of moving towards a more climate friendly environment and towards net zero. Obviously there's new products and stuff like that, but there's also an opportunity to increase your reputation and gain competitive advantage, because for us, our customers are mainly SMEs and they look to us as a guide. So we want to be starting our journey early so that our customers can turn to us and say, we don't know what to do, and we can guide them through that. So it's, although a challenge, is a really good opportunity. And I think as well, I come from a risk background, and inherently climate change is seen as a risk. But we need to also show that it isn't just a risk, that there are these opportunities to really do well, change businesses for the better, not just a one-tick exercise. And I guess another another pull factor is acquiring and retaining talent and customers. So for us at DF Capital, we want all our employees to share our values, that we want to do the right thing, and we want to do the right thing in our communities and change our communities and help them. So we want them to recognise that and share that, as well as our customers share those values, and see that we're accountable and transparent and wanting to do the right thing.
I'm extremely impressed with where you are, and especially like we talked about that you're like offline, that you're a smaller bank and you're already doing all of this work in a lot of senses are much further ahead than bigger banks. And it really shows that if you can do it, then anyone can really do it to tackle this net zero journey. And I also love what you said to me earlier the other week, that why wouldn't other banks do this? Like what is the reason not to? Like this is such a huge opportunity, both like the risks that you talked about, but then also capturing what comes with being on top of your carbon data. So I think that's a really interesting perspective, and thank you for sharing that, Lara. Elena, does this resonate with what you hear from other banks that you are speaking to, and what do you hear from the banking community out there? And also for those that Bankers for Net Zero, you represent a bunch of banks. Maybe you can talk a little bit about Bankers for Net Zero and how you work as well.
Yes, definitely. So Bankers for Net Zero is the UK country chapter of the United Nations Net Zero Banking Alliance. So what we do essentially is bring in banks, policymakers and regulators together just to advance their interest within the UK government. So we are mainly trying to advocate for policies that leads the country towards net zero and enabling these conversations between banks and the government to make the process easier and allow this to happen. But what Lara and with Torun have been speaking about clearly resonate with what we are hearing from the banks that we are speaking to in terms of the difficulties for banks to report on their Scope 3 emissions, mainly because to do that they need to engage the SMEs in their portfolios in decarbonization, and they need to have access to reliable and assurable data, and that's one of the main challenges. But overall, there has been an increased significance of environmental disclosures, and this trend is fundamentally altering how banks approach financial decision making, with a spotlight on sustainability that is very hard to ignore. And a key aspect of this is the focus on climate risk assessment. So companies are now expected to provide detailed insights into how climate-related risk may affect their operations and overall business strategies in general. And we've been seeing the publication of many policy frameworks in the past few years or even months. For example, the Task Force on Climate-Related Financial Disclosures has gained a lot of traction, and I'm sure you are very familiarized with it, but it just provides guidelines for voluntary climate-related financial disclosures just to help companies and investors understand and communicate the potential risks and opportunities associated with climate change. And we also saw the publication of the disclosure frameworks by the ISSB, which builds on the TCFD, but it serves more as a standard rather than a framework. So what I'm trying to say with this is that banks are just trying to navigate all these frameworks. So we do, from a policy perspective, we do have the guidance, but we need to put it into action, because the scrutiny is extending throughout the supply chain, and investors and customers are seeking a comprehensive understanding of the environmental footprint associated with it. So when it comes to sustainability reporting, banks need to engage their SMEs in their portfolios in decarbonization. And lastly, as we are moving into an increasingly data-oriented world, it is essential to ensure that the data that we have is assurable and reliable to mobilize green investments. So a very important trend is that banks are now exploring technologies and tools to enhance the accuracy and transparency of environmental disclosures.
Thank you. And I hear this resonates very well with what Torun was saying earlier, between closing the gap between the kind of commitments and the actions, and at the same time resonates with what Laura was saying, that, you know, investors and customers are asking for this, and this is something that, you know, proactively a bank needs to be able to show for in order to show that kind of proactiveness and capture these opportunities. A reminder to use the Q&A for questions if you have any questions for our panel. In the second section of today, we're going to zoom in a little bit about the crossroad moments that is also a big part of the finance white paper. Alex, can you describe the thesis of the white paper, the finance industry at a crossroads, and drawing from your experience from working with many banks, crossroads, and how this connects with what we just heard from the panel? Apologies.
Yes, no, definitely. And very, very exciting topic. And we already heard some voices that allude to there is a critical moment right now where it's important to, what are the next steps, like it's too important to decide on the next steps. So if I just were to quickly summarize a bit where we stand right now, what we heard right now, we see that climate disclosures and commitments are rising, which is of course an encouraging sign. We also see helpful movements and regulations, meaning they start to consolidate a bit more. At the same time, what we also see is that these regulations are increasing in breadth and also in depth, meaning they cover more industries, more sectors, more companies, also by company size, and they demand deeper and deeper disclosures. So they really go more deeply into the carbon-related specifics of a certain company. At the same time, Torun pointed out at the very beginning that comprehensive carbon disclosure right now is still missing, crucially missing, especially in scope 3 influential actors. And yeah, Elena, you just pointed out that these often includes then SMEs. They have to disclose their emissions as well as the companies need to get the data. So where does this lead us to? And that's the thesis, some you mentioned about the white paper, the thesis that we have in the white paper. That is this crossroads moment where companies can choose to take a reactive path, where they're going to be focused on meeting just the minimum regulatory requirements, just clearing the bar enough to kind of get by and to avoid the biggest risks there, and having business as usual without considering a lot of climate-related risks. And then there's the other part at this crossroads where companies can choose to be proactive. They can focus on really shaping the net zero transition, of not just clearing the bar, but we actually saw some of these movements, companies advocating for a higher bar, advocating for we need to have more comprehensive, comparable disclosures there. And we need to create, to Torun's point, net zero line portfolios and also new product offerings. So Lara, you mentioned there are also opportunities out there, right? So not just clearing the bar, but creating opportunities. So this is the crossroads moment where now we see where some companies choose to be reactive, others choose to be proactive.
Thank you, Alex. And you speak in the terms we, I do like that, but also when you speak about the comprehensive coverage and the work that needs to be done there, who in your opinion would you say is responsible for getting this right and for getting the comprehensive coverage across value chains, knowing that they are extremely complex and sometimes difficult to account for?
Yeah, I mean, ultimately, it is the large enterprises or financial institutions, organizations in general that have the means, resources to act here. We cannot say, oh yeah, we need to start, at the roots, all SMEs need to do this comprehensively on their own, alone. I mean, theoretically, yes, of course they should, but they should be taken on board and given, means and tools to actually collaborate here. I mean, we have this UN SME Climate Hub, which Normative has also been a co-founder of, where we want to enable companies on the SME level to also be able to disclose with free tools like our own carbon calculator. But there needs to be also, it needs to really come top down from these larger enterprises, organizations that enable and actually, again, to the point mentioned before, they want and they actively look into their scope 3 to value chain emissions. So this is where we really see there's the longest lever if you want.
Yeah, thank you. And I definitely say that we see a trend moving from the spend-based approach to primary data, really digging into your carbon emissions, working with your value chain, because enterprises do know and recognize that this is the only way to get the accurate readings of the carbon footprint, which is both, getting the opportunity side of things, but also mitigating the risks in terms of what could come in case you have like the big black box of your emissions. Elena, moving back to you, what reasons can you identify for choosing the reactive path that Alex spoke about?
So in the previous question that you asked, I spoke a little bit about the current policy frameworks that we have at the moment, not only globally, but also nationally. For example, only 2 weeks ago, we saw the publication of the disclosure framework by the Transition Plan Task Force. So what I want to say with this is that banks have an overwhelming choice of frameworks, and there is no policy clarity on direction of travel. So from a sustainability perspective, banks who are risk averse want to measure things. They want to be sure of their investments and the risk allocated to them. And what this requires is policy clarity and certainty from national governments, which has meant that banks cannot really plan their investments for the future when it comes to sustainability reporting or green finance. And some banks are obviously leaders in this space, but a lot of banks are still a bit cautious about green finance and really mobilizing a lot of capital towards net zero. And why is that? The reason is, as I said, from the policy side, there is a lot of complexity about measuring Scope 3 emissions, and there is not a best practice at the moment. So other organizations like the TCFD or the ISSB on the reporting side and the TPT. So we are only really starting to see, we are only really starting to have access to good guidance for banks just now. And also another reason why banks choose the reactive path is that in some countries there is maybe not enough regulatory pressure. And this can really shape the bank's approach because that's why maybe some banks might opt for a reactive stance, and also some competitive dynamics. When we speak to banks, they might be maybe they don't see that the peers are engaged enough in sustainable reporting or net zero in general. So they just adopt a wait and see approach. So they prefer to just assess the landscape just before making any strategic move. But that's why at Bankers for Net Zero, we are really supporting the financial services with becoming more proactive and just taking ambitions to lead net zero commitments into action, because this is what they need. They need organizations like this and government incentives and policy clarity to really start taking action and taking action towards measuring their Scope 3 emissions and following the path towards net zero.
Yes, definitely. Clarity for sure. And Torun, in terms of the risks, can you speak a little bit specifically to the risks that they face in terms of taking the reactive path and what you've seen?
Yeah. To take one step back, we often hear about the heavy reporting burden and the disclosure fatigue, etc. And the last 2 years, of course, a lot of focus has been on complying with a flurry of new regulations in EU, but also in the UK, for instance. And of course, for sustainable finance, transparency is an inevitable part of that. So disclosure is crucial. But we mustn't lose sight of the objective of this whole Sustainable Finance Action Plan, right? Which is, as Alexander mentioned in the beginning, is to shift the capital needed for the transition to take place. And we have to perceive it not just a compliance operation, but we have to translate it to actual business. And I think it's quite obvious to everyone that the transition entails enormous opportunities. And because of this financing gap that is so huge that has to be closed. And if you take a reactive path, you risk to fall behind your competitors, of course. Interestingly enough, when asked by CDP, financial institutions on average estimated their opportunities 4.5 times greater than the risks stemming from climate change and forests and water. It's clear, of course, that they underestimate the nature-related risk when compared with the scale of risk that is recognized by the real economy companies. But still, it's very encouraging that they see great opportunities, and it's built on a strong client demand for products such as green bonds, green loans, green insurance products, and of course also green investments. For these products to work, of course, transparency, as I said, is key. And yeah, I wanted to mention, because Laura and Elna, you were also mentioning that the problem with data from SMEs, etc. And one area where we see at the moment a rising tide of interest is environmental data to underpin supply chain finance. And that means companies want to encourage their suppliers to report and take action on environmental issues to reduce their financing costs. And these suppliers are often SMEs, and they are based in all parts of the world. And it's super encouraging that banks set up these programs with their clients to actually help and guide all these hundreds or even thousands suppliers to perform better on and disclose on environmental issues.
Thank you. And I love the opportunistic way of looking at things with a 4.5 times greater opportunity. But of course, there is also the risk that shouldn't be underestimated. Laura, on the proactive side of things, and I think here we definitely can speak about the opportunity. What was the biggest reason from your perspective on taking this proactive path, and why did you, what is the drivers behind that decision from your end?
I think you covered it before, what we talked about a couple of weeks ago, with our initial stance of myself personally, but the whole business, including our senior leadership, is, well, why wouldn't we? It's never why should we do that? With every regulatory piece, you have to do it. But with this piece in particular, it's how can we do this to the best of our ability and move it from a risk compliance exercise into the opportunities that we've spoke about. So we have been disclosing for the last 2 years as an overall emissions factor, and now that we're working with Normative to make our emissions reporting more accurate and more transparent. And the reason we wanted to do that is because we want to understand the impact of our business and the impact that has on the planet, as well as helping our customers understand what their business's impact is as well. And I think as a bank, we decided that it wasn't a choice to just sit back and, like you said, let the bigger banks do this, or let the banks that came before us to clean up their mess type thing. That's not what this is. This is about moving towards a better world, towards a more climate friendly world. And then I think we want to change the way we do business, not just complete it and say, these are our emissions, tick, that's done. We want to implement this, understand our emissions and reduce them in a sustainable manner. I think it's really important that the data side that everyone has spoke about, that the data here is really important. Understanding what your impact is and then how you can reduce that. Because we don't just want it to end with, these are our disclosures, and there's no transition plan, like Torun touched on earlier. There's no transition plan into, well, how are you going to reduce that? And I think we are very open, about the fact that we're on a journey, and I think that is quite refreshing in the financial industry, and it would be great to hear a lot more financial institutions take that approach of admitting this is a journey. We don't know the answer now to solving the climate crisis. We don't know the answer even to these disclosures, but we do know it's a journey, and we're willing to start as soon as possible to get results and to change the way that banks do business.
Thank you. Definitely turn the results into the way banks do business. I love that quote from you. We're getting a couple of questions into the Q&A, and this one is for you, Alex. A lot of companies are using spend-based data to calculate CO2 emissions, and this will result in an average overview of the company's emissions, which may lead to greenwashing. And how do we avoid that? And specifically, Alex, you can respond to a little bit what's going on in the industry, but also the latest from Normative with our Engage module and how we work with value chain engagement from our perspective. Please.
Happy to, and try to make it brief because I know we are approaching end of the allocate time already. So with spend-based, yes, so I see that the question is linked to greenwashing. I would say in general, let's focus on the action part first. Spend data don't allow you a lot of powerful ways to action, right? What can you do when you have a spend-based analysis? Well, you can spend less money, you can spend money differently, but otherwise you have no more insight. So it's really just there to establish a certain baseline, and then you need to go deeper. And that's then probably also where greenwashing risks emerge. If you leave it with spend-based, you say, that's apparently my emissions, and now I do a few actions here and there, some policy limitations inside the company. Like, you don't really go deeper. And we heard now from all of the panelists here that data is so crucial. So you need to get to the level of supplier specific information, or for finance, often it is what is actually in my investments. Like Torin, I'm not sure if Torin actually mentioned the number, but 750 times, that's the amount that Scope 3 emissions are larger in finance than their own operational emissions. So it's critical. And how you do this? Well, only through engaging your suppliers, your vendors, your value chain, or look into your investments for finance. And you mentioned the name Engage. So we, from normative side, with our carbon accounting tool, we have recognized this need, of course, and we try to connect more smoothly the big buyers, enterprises, with their suppliers to get primary data that also Elena pointed out is so crucial. So you can seamlessly connect with your suppliers, with your vendors, or with your investments to get their own Scope 1, Scope 2, Scope 3 data to get a more accurate picture, and then you can take really specific action that fits your own net zero strategy.
Exactly. And it's all about that seamless connection of getting your primary data from your suppliers and moving away from heavy workload intense type of carbon accounting to finding automated way that makes sense for the suppliers, but also from the enterprise perspective to connect these data points to make sure that you have those real insights that can drive real reductions. We have a couple of minutes left. So for the panel, I have one question left for each one of you, and please keep it brief, within a sentence. We're going to look at what are the biggest hurdles to overcome when organizations want to embark on the proactive path. And I know this is a big question, something that you love to speak about, but what would be your kind of key recommendation? What is the hurdle and what is your recommendation to overcome that? We could start with you, Torin.
Yes, of course, I see that now there is a lot of data out there, but still there are, well, maybe not always usable, but it's also that there are data is missing for certain asset classes, regions, etc. And as mentioned previously, SMEs. And to keep it very short, we see, for instance, that disclosure rates through CDP is still like under 50% of the companies we ask, they actually do disclose. So one thing that you could do to overcome this particular hurdle and improve transparency is to actually sign up to CDP and as a financial institutions, and you can then take part in the collaborative engagement to request disclosure, more disclosure and better disclosure from companies.
Thank you. And Elena, from your perspective in Bankers for Net Zero.
Thank you, Cassandra. So as Torin just mentioned, there is a lot of data at the moment, but however, the data that we need is data from SMEs. Banks need the data from their SMEs in their portfolios to successfully report on their greenhouse gas emissions and disclosures. So something that the banks can do is to engage with automated data sets that gets the data from SMEs, and we already have solutions for the banks to get this assurable data from source. Bankers for Net Zero is working on a program with our partners at Icebreaker One called Project Perseus, and it has already been recognized in the UK Green Finance Strategy as the pathway to lead the country towards its decarbonisation efforts. And just to clarify, this is not a carbon calculator. There is already a lot of out there, and those are built on proxy data, estimations, spend-based analysis, and this is hampering investment decision making. So this could just be an automated process to get primary data flowing from energy companies to banks with the permission of the SMEs to get automated data flowing to banks using the principles of open banking. So this is something that banks and financial institutions are already doing, and they can join Perseus to get this automated data flow.
Thank you. And Laura, from your perspective, same question.
I won't say data because I think we all recognise that is the biggest hurdle in this, but maybe a secondary hurdle to data is target setting that's not backed by data. I think there's some unrealistic, unattainable targets that may have been set or will be being set by companies or even governments, for example. And when it's not backed by data, that can sometimes mean it can lead to offsetting, or it can lead to greenwashing and not true actions taken to actually achieve that target, because there was no base to begin with. So I think target setting only based on data, whether that data is complete, obviously we've all discussed that it probably isn't complete right now, but just working towards having an actual base and not just a guess of will be net zero by X.
Thank you. So data is the big word that I'm hearing from different perspectives. If you want to deep dive into the finance industry and the crossroads, seeing where they are, the argumentations for the proactive path and recommendations from such likes as Elena and Torun and their peers, then download the white paper. We're here at Normative to answer any questions, so always feel free to reach out if there's anything else that you'd like to know. But with that, our time together has come to an end. Please stay and fill in the 3 questions. That is very important for us in order to get better with our webinars. As mentioned, this webinar is recorded, so you can watch it afterwards. And with that, thank you to our speakers and to everyone listening in. The finance industry is at a crossroad, but I hear that there is a lot of hope. We need accuracy, we need actionable insights, and we need to get on top of our Scope 3 emissions in order to get there, to bridge the gap between the commitments and the actions. Thank you, everyone, and wishing you a great day.